welcome to these sessions. My name is Martín Cicowiez, and I will be talking about social accounting matrices and computable general equilibrium. So please feel free to interrupt. If you have questions, I will be happy to answer them. So let me start by sharing my screen, and I will try to give you a quick overview of the topics I will be touching during this today and the 4 days during the next week. So let's share everything. Okay. So here you have my email. In case you need to contact me, please do so. Okay, so first we will start by talking about social accounting matrices and general equilibrium model. That is what we are going to be doing today. Just a gentle introduction. And you will have some optional homeworks. That's you decide if you want to do them or not. You can do them after the course. There is no need to do them while taking the course. Then next week, we are going to talk about a specific general equilibrium model, which is called GEMCare. That is a model that we developed together with Hans Lofren, which is a colleague of mine. We developed a model that is focused on gender and the care economy. It is a computable general equilibrium model. And that is the topic of next week. Today we are going to talk about one of the data inputs, the most important one that we need to make that model operational. Okay, and then we will go into the details of that model, and we are going to run some simulations with that model, and we are going to look at the results and I will try to explain, I will try to sell you the idea that talking about these issues in the context of general equilibrium approach makes sense for several reasons. That is basically the idea. Why it makes sense to think about these issues in terms of a general equilibrium approach. Okay, I prepared a website with materials and some software that we are going to be using. Actually, I will be running the simulations. I will be sharing with you the results. But if you would like to replicate what I am doing, you will need to install some software. Everything is at the website. So you can download the software, follow the instructions, and you will be ready to go. In case you have problems, or in case you have problems with the installation of the software, just let me know and we will try to find the solution. And this is for next week. And these are my office hours. And so you have them in the presentation, and the same presentation is already uploaded to the website. So you have all this, it's already available to you. Okay. So let's talk about social accounting matrices. Is that a question or no? Let me. Sorry about this. Okay. Okay, so I will go through a quick introduction to CGE models, computable general equilibrium models, and then we are going to talk about social accounting matrices and how do they relate to the input-output matrices. In case you are familiar with input-output matrices and not with social accounting matrix, that this will be like, it will be useful to know the relationship between both of them. Okay, so what is a CGE model? First of all, CGE model is computer representation of a real economy, which means that we build a computer model that is that is like the counterpart of a real economy. And given that this is a general equilibrium model, it will show the links between the different components of the economy, which means that it will have productive sectors, usually more than one. It will have factors of production, like labor, capital, and natural resources. In the case of labor, it will have more than one. In our case, at least, it will have at least male and female labor. It will have households, government, and the rest of the world will be part of the model as capturing the balance of payments. So a CGE model will be a representation of the economy with all its elements, and it will have the connection between the different elements. From a mathematical point of view, a CGE model is a system of simultaneous nonlinear equations. And we are going to have like 3 different types of equations. We have behavioral equations, like we are going to assume that households maximize utility and producers maximize profits. And by solving those problems, we are going to get the behavioral equations for these different agents. Then we are going to have equilibrium conditions, like savings will be equal to investment or supply will be equal to demand, generally speaking. And then we are going to have definitions, like we are going to define that the income of the households is equal to the value of the factor endowments of the household plus the transfers that the household might be receiving from the rest of the world or the government. So the idea is that we are going to believe, let's say, in economic theory, which means that we are going to build a model based on economic theory, and then we are going to introduce that model into a computer, and we are going to make that model reflect the economy of a given country, which means that we are going to calibrate the model so that it is a reflection of an economy like Korea or Colombia or any other country for which we have enough data to make the model operational or to calibrate the model. But the important point is that we are going to believe in economic theory, which means that we are going to be doing like theory with numbers. Okay, that's very important. And then, given that we are going to be using a general equilibrium model, anything that we get from the model will be consistent in the sense that anything that we get from the model, we should be able to explain within the logic of the model, because everything is taken into account within the model itself. So you might say, okay, you might argue that you might say that you don't believe in the results from a given CGE model, but even if it is, let's say, if the model is lying in a sense, it will be a consistent lie, which means that, again, we are going to be able to explain the result within the logic of the model. And I mean by that we are going to say which are the main transmission channels to explain the different results. And given that this is a numerical model, we are going to say, we are going to be able to say which are the most important transmission channels. So if we think of a model in terms of a figure, this is one such figure. And this is showing what we are going to have, I would say, in almost any CGE model in the literature. So we have factor markets, we have 2 commodity markets, these are product markets. Then we have the activities, which are the ones that produce using intermediate inputs and domestic and intermediate inputs and factors of production, like labor, capital, and natural resources. And we also see that the income, the factor incomes will go to the households because the households are the owners of the factors. And then the households will use that income to buy commodities, okay? And that is basically the circular flow of funds or the circular flow of income in an economy. It's the activities using factors to produce, the household receiving the income of the households, and then the household going to the market and to buy commodities, and then we start all over again. Besides, we have the government that will be collecting taxes, both direct taxes and indirect taxes, and it will be doing transfers with that income, and it will be also buying products with that income. And we also have the capital account, which will be collecting savings from the households and from the government, which might be like negative savings if the government is running a deficit. And then we have the rest of the world, which will be supplying the imports of the country, and it will be buying the exports of the countries. So the idea of this figure is that if we introduce a change in in any of the exogenous variables, like the transfers from the government to the households, that will have a direct impact on the household, but it will have indirect impact throughout the system. Like, for example, if the household increases the transfers to the households will have more income. And with that income, the households will likely increase consumption and maybe savings. But at the same time, the government will have to pay for those transfers, for those additional transfers, which means that some component of the government revenue will have to increase, or there will have to be an element on the government expenditures that will have to decrease. Okay, and the fact that the household, the governments, and the firms and the rest of the world have budget constraints, and that we are going to be taking those constraints into account, is what makes this general equilibrium approach basically different from a partial equilibrium approach, in which we don't have to take into account all the budget constraints at the same time. Okay, so this is basically what we are going to have within the model. We are going to see at the equations behind this figure at some point. But if you think in the model about the model in these terms, we can start to think about the data that we will need to calibrate the model, to make this model operational. Okay, so we have all these relationships between the different components of the economy. Like, for example, we have the production functions, and we also have the factor markets, and we will link them through a production function. And if you think about the production function like a Cobb-Douglas production function or a CES production function, those functions have like parameters, and we will need to provide the values of those parameters. And for that, we are going to need a social accounting matrix, which is the most important data input for this type of models. So generally speaking, all models have a common core, and that is what I just showed. Any CG model will have a common core, and that is what we saw in the figure. For producers and consumers, we have like explicit decision rules, and we have the budget constraints, and they act in markets. So it's not necessary that all markets are like always in equilibrium, but if we use this type of model, we are assuming that prices have an important role to play when producers and consumers and are taking decisions. Okay, so there is a role for the price system to play in these models. Of course, we can assume that there is unemployment in the labor market. We can assume that there is excess capacity for capital, and we can assume that some prices are exogenously fixed because, for example, there is a price regulation. That is possible to do, but generally speaking, we will be assuming that markets are relevant in this type of model. The social accounting matrix, as I said, is a major data source for this type of model, and that is what we are going to be talking about the next slide. If you look at the literature, these type of models are usually used for an ex-ante analysis of different topics, such as trade, taxation. These are the two topics that these were two of the topics that that were like the original used of CGE models. Nowadays, they are also used for poverty analysis and inequality analysis, natural resources and the environment, like labor issues, demography, and also the care economy. Okay, so questions, comments, anything? Okay, so again, let's just feel free to interrupt me when I'm talking. So what is a SAM? What is a social accounting matrix? Okay, first of all, it's an economy-wide data framework, which means that with the social accounting matrix, we are going to have like a picture of the whole economy. Okay, it's not only production, it's not only the households, it's the whole economy, and we are going to be looking at the whole economy at the same time. That is why it is comprehensive. If you look at this at the social accounting matrix, it is a square matrix in the sense that we have the same accounts in the rows and in the columns. And each cell of this matrix will show a payment from the column to the row. Okay, so that is what we are going to have in each cell of a social accounting matrix. These are expressed usually at current prices, which means that we have values in a social accounting matrix, and we are going to talk about how we can combine values in the social accounting matrix with satellite accounts, like for example, on hours of work, of or like tons of output. We can do that, but if we look at the social accounting matrix, it will be expressed in values. Okay, and we can use the sum to describe the economy because it will show the relationship between all the different components of the economy, and it's very useful for that. But we can also use the sum, the social accounting matrix, as an input for CGE models, or we can use it as an input for fixed price multipliers models also, which is a different type of model that can be calibrated with the social accounting matrix. Okay. Okay, so before we look into a specific social accounting matrix, let me make a distinction between what we have in the GDP sectors and what we have in the non-GDP sectors. Okay, if we look at the national accounts, we only have GDP sectors. That is what the national accounts covers. And in these sessions, we are going to be talking about the GDP component of the economy. Okay, but within the GDP, we have the market transactions. These are transactions for which we have a market, like when we buy something at the supermarket. We also have what is called non-market production, typically by the government. When the government is providing like public education for free, that is non-market production, but that non-market production is part of the GDP. Okay, so again, if the government is providing a service for free, that is part of the GDP, but it's non-market. And then we have home production for home consumption of goods. That is also non-market, but it is part of the GDP. Like when you have, like for example, a rural household that produces and consumes part of its production, that is home production for home consumption of a good that is non-market, but it's part of the GDP. Like said there, like food for self-consumption. That is also part of the GDP. What is not part of the GDP, and which is what we are going to be covering in the next section, in the next session, is the home production for home consumption of services, like care, okay, or domestic work. That is not part of the GDP, and so it will be not covered in a basic, in a relatively simple social accounting matrix. And what we are going to be doing is we are going to be expanding this simplest social accounting matrix that only covers GDP to cover the non-GDP economy. As an example, as it is said there, unpaid domestic and care work. That is not part of the GDP, so we are going to be expanding the system of national accounts. Okay, so how do we build a social accounting matrix? So we usually start with a macro social accounting matrix that is easy to build simply using the national accounts. And the idea is that once we have the national accounts, and from those national accounts, we build the social accounting matrix, and you have an exercise, an optional exercise to build a macro social accounting matrix that is at the website. And once we have that, we are going to assume that that's true in the sense that we're going to use that macro social accounting matrix as a total control totals for building the more disaggregated social accounting matrix, which we are going to be calling a meso social accounting matrix. We are not calling it micro because we are going to be working at the sectoral levels. We are going to have let's say at most 100 sectors. It really depends on the country, but we are not going to be working with a individual firms or individual households within the social accounting matrix. So that is why I'm not calling it a micro social accounting matrix, but a meso, in the middle, social accounting matrix. Okay, we are going to have some sectors, but not all of them. What do we need to build the social accounting matrix? We typically need the supply and use tables, which most countries produce every year or every 5 or 10 years. Most of them every 5 or 10 years. But even in those cases, it is possible to update a supply and use table using techniques, different techniques, such as cross-entropy or Rust. These are techniques that can be used to update a supply and use tables. Okay, and the data that you get from a supply and use table, for those of you that are not familiar with them, it's basically information on production and the use of that production. Okay, how the different sectors produce, which factors they use, which intermediate inputs they use, and then who buys that production. Okay, are they the activities buying intermediate inputs, or the households also buying goods and services? And then we also have, the integrated economic accounts, which cover not the production side of the economy, but the institutional side of the economy. Like, what is the source of income for the households? What is the source of income for the government? And what is the relationship between the different sectors in the domestic economy with the rest of the world? That is what we have in integrated economic accounts, which is also part of the national accounts. This part of the national accounts, not all the countries have them, but we can, let's say, build them using data for the government receipts and expenditures, and also data from the balance of payments. Okay, so let me show you an example of a social accounting matrix. This is for Korea 2018, and this was built using supply and use table and integrated economic accounts. Okay, and in this case, we have more than one labor category, and we use a household survey for that. Okay, so this is this is a social accounting matrix for Korea. It's a two-sector social accounting matrix. We have the accounts here. In the next slide, you have the explanation of the different accounts. First, we have two activities. These are like industries. These are the activities are the ones like producing, using intermediate inputs and factors. We have two commodities. This is, here we have the reproductive sector that is part of the GDP, or the care sector that is part of the GDP. Here we have domestic work that is part of the GDP, like when someone is working at your house. Then we have elderly care and child care. But we have those sectors aggregated into one, but we are only considering here what is part of the GDP economy. Okay, we are not talking yet about the non-GDP sectors or the unpaid domestic and care work. And all the other sectors are together into one. And we only have two sectors so that we can see the numbers into a PowerPoint. That's the only reason. Okay, the data that we are using for the model has many more sectors. Okay, so we have the activities and the commodities, and we make a distinction between activities and commodities because the national accounts, they do exactly the same distinction. We have activities and commodities in the national account, and we actually use different classifications for the two of them. We use the ISIC classification, the international, the industrial classification for activities, and the central product classification, which is more disaggregated for commodities. And it allows the use of two different classifications allows us to capture the fact that one industry or one activity can have multiple outputs. Like you can have a farm or the agricultural sector producing different commodities, such as crops and livestock, for example. So there is no need to have a one-to-one relationship between activities and commodities. And all the numbers in this table are showed as GDP shares. So this number here means that the non-care sectors or the non-GDP care sectors in Korea, they paid to male labor the equivalent of 34% of GDP. And they paid to female labor the equivalent of 14% of GDP. And the rest went to capital. The rest of value added, okay, went to capital, and a small share, a 1% share of GDP, that went to taxes on activities. Okay, so what we see here in the first two columns are the cost structures of the GDP care sectors and the non-care GDP sectors. Okay, so we learn from these numbers that the care sector is relatively more intensive in the use of female labor. Okay, this is female labor, male labor, and the ratio between female and male labor is higher for the care GDP sector. Okay, And if we compare the size of the two sectors, of course, not surprisingly, the care sector is smaller relative to the rest of the economy. Okay, here we have the intermediate inputs. This is the domestic output. Okay, this is total domestic output. These are the activities selling to the commodity accounts. So this is domestic output. And then we have that the non-care sectors, they make a payment to the margins account. These are trade and transport margins. This is the trade and transport services that we need to move the production from the farm gate or the factory gate to the market. Okay, so this is the production at basic prices. These are called like the production at the factory gate or the farm gate, that is called at basic prices. And we add to that the trade and transport margins, which is what we need to move the goods from one place to from the factory to the supermarket, let's say. And then we add the indirect taxes on commodities. And then we have the domestic production at purchaser prices. Before this was called market prices. Now it is called purchaser prices. And then we have the imports. This is a payment from the commodity account to the rest of the world. That is what we have here. These are imports. And the total here, this is the total supply at purchaser prices. So this is the total supply. So if we look at the row for the commodities, again, we have the intermediate consumption, the trade and transport margins. These are making payments typically to the trade and transport commodities. And then we have the consumption by the households, the government, and the rest of the world. And then we have investment. So these are the components of the final demand plus exports. So this is total demand. And we see that total demand is equal to total supply, both for the GDP commodities, the non-care commodities and the care commodities. Okay, so demand is equal to supply, which means that we are in equilibrium. And then if we look at the columns for factors, we see that most of the factor income is transferred to the household. Okay. And we also see some transfers to the rest of the world. So these are workers from the rest of the world that temporarily are working in Korea. So the labor income goes to the rest of the world. And then we have some capital income that goes to the government. And that is because the government is also the owner of some of the capital that is being used in Korea. And then we see that the tax income or the tax revenue goes to the government. And finally, we have the transfers between the different institutions, which are the household, the government, and the rest of the world. Okay, and we also see that the households, they pay direct taxes. Okay, so again, what we have here is a picture of the whole economy, and we see how the different part interacts. Right now, we are only covering the GDP economy. And when we move from the social accounting matrix to the model, we are going to have equations for the different transactions that we see in this social accounting matrix. And we should be able to link any of the equations in the model to what we are seeing in the social accounting matrix. For example, these are household demands. So in the model, we are going to have equations, behavioral equations for the household demands. Okay. If we look at the total for the household column, that is total household spending. And that has to be equal to the total household income. That is the budget constraint. Okay. Here we should say that one of the household spending items is savings. Okay, this almost 28% of GDP, those are the savings of the households. Okay, and we see that household savings plus government savings and savings by the rest of the world, those are used to finance the investment. Okay, so savings are equal to investments. Okay, so this is the social accounting matrix, and the different sources of information that I mentioned before are used to build the social accounting matrix, like the supply and use tables that are related to production and consumption, or supply and use. They will cover these parts, these parts here, and the consumption here. And then the transactions related to factors and institutions, those are covered in the integrated economic accounts, or in the government budget, or the current account of the balance of payments. Like, for example, the transfers from the rest of the world to the households, like remittances, that is part of the current account of the balance of payments. Okay. Okay, so if you are familiar with the input-output tables, you should notice that the difference between an input-output table and the social accounting matrix is that in a social accounting matrix, we close the system. If you think of an input-output matrix, you will see that you only have sectors and, let's say, final consumption. And I'm here calling it households. Okay, so this is what you have in an input-output matrix. It's a very small one, but this is basically what you have. You have the sectors making payments to the sector themselves, because here we don't usually distinguish between activities and commodities, so we consider them together. So we have intermediate consumption, and then we have value added. These are the sectors, the productive sectors, making payment to the factors. And then we have the households making payment to the sectors, which means that there is no link between the household or the final demands and their incomes. Okay, so in an input-output matrix, we can only talk about the functional distribution of income, like how much goes to the labor factor and how much goes to the capital factors. In a social accounting matrix, we basically close the system, and we link the factors with the different institutions, the household, the rest of the world, and the government. And so we can talk about the functional distribution of income, and also the size distribution of income, or the personal distribution of income. Okay, so we know the sources of income for the different institutions, and that's the main difference. And what you get from an input-output matrix are usually called, like, you can get a very simple model with open multipliers, and here we have closed multipliers, in the sense that there's a linkage between, again, spendings and incomes. Okay. In a social accounting matrix, we can capture the feedback effects, in the sense that if we look at the household consumption, the household is paying for that through the household income, and if there is an increase in income, and we look at that in a social accounting matrix, that will have an income, that will have an increase in the consumption of the households, and that will have like feedback effects in the production sectors, because the production sectors are linked through the input-output relationships between them. Okay, so I will skip this. We already talked about this. The sum is square, is comprehensive, and it's flexible. Okay, we can have like social accounting matrices of different size. So that the different numbers of activities, commodities, or households. And we can use a social accounting matrix to describe the economy for modeling purposes. And if you are in a situation in which you have to build your social accounting matrix using different sources of information, the sum will force you to have to make like data reconciliation in the sense that you cannot have two different numbers for government revenue. So if you have one estimate from one source and a different estimate for a different source, you will have to make them consistent in order to build a social accounting matrix. And that in itself is very, very useful. Okay, and this is what I said. And once we have a social accounting matrix that, as I show you, is a picture of a given economy. Imagine that we have more than one activity, more than one commodity, and then we want to use that table to calibrate the model. And this is what we are going to be doing next week. And by calibration, we mean making the model consistent, the behavioral equations of the model and all the equations of the model consistent with what we have in the data set for the country that we are modeling. Okay, so let's assume that we have a production function like this one. Okay, this is a Cobb-Douglas production function. We have the output here for activity A, and we have more than one activity. K is the amount of the quantity of capital services that are being used by these activities. Then we have male labor and female labor. Okay, and we have the different parameters. This is a scale parameter, and these are the share parameters of the Cobb-Douglas production functions: the capital share, labor share, and labor share for males and females. And if we want to calibrate the model, that means that we have to provide values of the different parameters that are going to be consistent with the information that we have in the social accounting matrix. Okay. So if we have in the social accounting matrix that capital is receiving like 40% of the factor payments in a given activities, this parameter for capital will be 40%. Okay, and that is because we are using a Cobb-Douglas function. And if we look into the details of the first order conditions for the profit maximization of the producers, we can see that that is how this parameter here must be read. It shows the share of the factor income, total factor incomes that goes to the capital. But this is what we are going to be doing next week. Basically, we are going to be using the social accounting matrix to provide the values of the different functions that we have in the CGE model. Okay, that is for the Cobb-Douglas function. But next week we are going to be using the more complex CES function. Okay, because it gives us like more flexibility in the sense that we have an additional parameter that measures how easy it is to producers, for producers or consumer, to substitute one input for the other one. Okay, and here we are applying the CES function, the constant elasticity of substitution production function, to the value-added production. Again, we have capital, male labor, and female labor. Okay. And again, this is a social accounting matrix that shows you the different cells that we might have in a social accounting matrix. Of course, in a real one, we are going to have numbers instead of text. Okay, so let me stop there.
Hi, good morning, everyone. My name is Ajit Cicowiez, and I'm going to present a joint work that was done with colleagues at the Levy Institute. And this is a presentation in 4 parts. So I'm going to start things off today, and which will basically be an overview of the policy problem or the practical problem that we were trying to study, and an overview of the methods that we use to answer the questions. And this has a macro part, and Martin's presentation was really useful because we will be using a SAM-based macro model for our modeling. And the other part is the micro simulation part, which also Martin touched upon. And that's then the third and the fourth sessions of the presentation will focus on that. So without further ado, let me get started here. Can I share the screen, Catherine? Am I set up to do that?
Yes, you should be able to.
I see who can share, only host and all participants. Maybe I'm not host. Should I just
try it? It looks like you should be able to.
No. I see a screen which says advanced sharing options and who can share. It says only host. Maybe you have to make me a host.
Yeah. Catherine, I think that there are some Zoom links that do not allow co-host sharing of screen.
Oh.
That might be the case. So
this is not one of those.
No, Martin just shared, so you should be able to. If you just press share screen instead of the arrow.
Ah, I see what you mean.
Yeah.
Oh, there we go. That's it. Okay, can you see my screen now?
Yes.
Okay, good, thank you. Okay, so what we're going to look at are the impacts of improving physical and social infrastructure. And we're going to do it in the context of 2 countries from sub-Saharan Africa, Ghana and Tanzania. And the model that we are going to examine these effects is a micro simulation model. Let me start by talking about, well, help if I can go. Okay, so in this part, today's lecture, today's session, we will focus on an overview of the proposed policy interventions and their outcomes. So to start with the context here, it's research in feminist economics. There's been a long-standing emphasis on the role of physical and social infrastructure as determinants of the time that women spend on household production. By household production, we mean basically the same set of activities that was referred to by Martin. This is unpaid care and domestic chore services. Going back to Diane Nelson in her 1991 book on male bias in the development process, she had pointed out how austerity measures, which now unfortunately many of us in the global south are dealing with, reductions in public expenditures on health, education, water supply, sanitation, and rural transportation, often translate into increased household and care responsibilities for women. From recent the literature, we have an econometric analysis by Eveline Bamboy and Stephanie Seguino. What they looked at was the determinants of female labor supply in sub-Saharan Africa. And the estimates that they have suggest that improvements in physical infrastructure has a positive effect on women's labor supply in the regressions that they ran. Now, they speculate that this may be because of the reduction in household responsibilities, but that's not directly incorporated into the model. So let's look at the two aspects, the context of research regarding physical infrastructure and social infrastructure. And for physical infrastructure, we are going to mainly talk about transportation. So here, especially roads. So there's a literature there, mainly by anthropologists, on spatial poverty traps. And the idea here is that the inability to access proper transport facilities, if they're basically talking about roads, the condition of roads, that has an effect on limiting educational opportunities and income generation opportunities, and also access to healthcare. And this seems to affect women more adversely than men. The work on Ghana by Gina Porter is one of the earlier ones to posit this notion of spatial poverty traps. We have some survey evidence from Tanzania that goes back all the way to 1986 about the disparity between an adult female and adult male in terms of the time that they spend on transportation. Then there is also more recent literature, not necessarily within the feminist economics tradition, but from other empirical work that, for example, for Pakistan, the results show that the better access to roads increase the use of prenatal care and childbirth under skilled attendants as opposed to giving birth at home. There's also evidence from Laos, PDR, and Bangladesh that better access to road reduced women's time spent on household production. And also there is some evidence that it enabled them to engage in income generation opportunities. But overall, if you take into account the body of research that's out there on this topic, you can see that there is a certain degree of ambiguity. That is improvement in roads or access to roads always a positive outcome for women in terms of their time burdens? And there, the evidence is mixed, because better access to roads may mean that you engage, say, in market work or you get a job. At the same time, if your traditional roles as a caregiver in the family is fixed and you don't get any slack on that front, it may actually lead to increased time burden. So this is an interesting question, a research question that one has to address. Now, with respect to the next element that we are looking at, so that's the physical infrastructure part, looking at roads. The other has to do with the social infrastructure. In our context, early childhood education. Now, surprisingly, there is a dearth of studies that directly investigates how improvements in access to care changes the time spent on household production by men, women, and girls and boys. The one study that I'm aware of that looks at this directly is a pilot study that was done by people at Oxfam, focusing on Uganda and Zimbabwe, and where they find that the direct impact of better childcare services is rather ambiguous. That is, if you look at their linear model estimates, the effect on time spent on unpaid activities appears to be negative. So that's counterintuitive. You kind of expect that better childcare options, better services of that nature would reduce women's unpaid care work time. But what they find is the opposite. Now, it's an interesting question as to why they do, and we can think about it and we can talk about it maybe later at the discussion time. But I leave it. I may just make a note of that for now. Interestingly, much more has been done by feminist economists on looking at the macroeconomic impacts of the expansion of ECE, or early childhood education. They have looked mainly at employment, the impact on employment, but they ignore effects that go beyond that of job creation. For example, foreign deficit or government deficit. Now, these are crucial policy constraints for the global south. And let me just discuss why. But before that, let's just recall what the models that account for direct and indirect job creation from ECE expansion find. Okay, now this is typically done using input-output models, not SAMs, like Martin talked about the relationship between the two. So the general finding is that it improves the fiscal stimulus that is invested in care activities. It gives a boost to the GDP and also boosts employment overall. Particularly, it raises the employment rate of women, and it also has a host of favorable distributional outcomes. It reduces gender pay disparity, lowers the incidence of income poverty, and diminishes the degree of income inequality. But this type of exercises generally ignore the changes in external deficit, for example. That's a crucial policy constraint for the global south. For example, investing in roads and ECE may place demands on the foreign exchange reserves of the country. Now, you may not be able to meet such demands if you have a problem of external indebtedness. And also, you have limited policy autonomy. Say you're under some conditional, under some kind of IMF conditionalities, then you may not have the freedom to actually do that, or you have only limited freedom to do that. So we try to address this gap in the literature by developing a fully articulated SAM-based macro model. The other side of the problem is that often the models that account for direct and indirect job creation, they ignore the impact of job creation on the time demands that are faced by individuals, particularly women. So to address this task, we develop a micro simulation model of time allocation and time demands. Okay. What do we mean by that? How do we look at that? So to look at the time demands and the time deficits, we use this framework that's been developed at the Levy Institute, which is called the Levy Institute measure of time and income or consumption poverty, depending on whether income or consumption is used as a yardstick for measuring poverty. So it's simply based on the idea that a poverty line should include, as it does conventionally, certain minimum consumption requirements, but also time requirements that all of us have, all individuals have, in terms of personal care, in terms of household responsibilities, and commuting. So over the last few years, we have carried out studies in a number of countries, and the years for which they were done are shown in the parenthesis there. And what we have found is that taking time deficits into account changes the picture regarding deprivation in general, and especially for women. Now, improving roads and expanding access to ECE can lower the time requirements for household production. Why? Because childcare time can be reduced. And also through reducing the time that people have to set aside for commuting to a job. So other things being equal, what we expect to see is that these improvements would result in lowering time deficits and also thereby taking out some of the impoverishing effects of time deficits. So a quick overview of how we account for time poverty. To start with, the first equation, that's just showing the time balance of individual I in household J. So the letter X on the left-hand side of that equation is the time balance of the individual. So now that's simply computed as what is left over from the total available, physically available number of hours in a week. That's 24 times 7, that's 168. From which we take out a certain amount of time that has been spent on personal care. We assume that this is the same for everyone. For example, a certain number of hours for sleeping, certain number of hours for eating and drinking, and certain amount of time for personal hygiene and activities of that nature. The next item in the equation on the right-hand side is a product of two factors. So the capital letter R, the underscore J, indicates the threshold of household production. That is, in a household of this type, the jth household, how much time is required, taking together all the members that are there in that household, to meet the household production requirements of that household. And later on in the discussion, we'll see how that can be estimated and so on. For now, let's just focus on the conceptual part of what's going on here. Now, that's at the household level. Now, what does that mean for the individual? Well, that depends on the variable alpha ij, which is the share of this total household responsibility, the total number of hours that's required for the household as a whole, that falls to the individual. So that's the share. So you can think about it as reflecting the balance of forces within the household between individuals, primarily that between, say, men and women or boys and girls. So that's the parameter that will determine how much time you spend actually on household production activities. And then there is a final term. We have a dummy there for whether you're employed or not. Why? Well, because only employed people spend time working, that is engaged in productive or outside employment, income generation activities. That's denoted by the letter Lij, and I think the terms should be reversed there, that it should be Lij minus Tij. I'm sorry about that, that's a typo. The difference between how much time you work, there should be an addition. I'm sorry, it's not a subtraction sign. It should be Tij plus Lij. That's the total time that you spend on employment, the actual hours of employment plus the threshold hours of commuting. So taking out of 168 hours, these components gives us the time balance of the individuals. Now from there, to move to the time deficit of the household as a whole, this is, remember, the first equation for the individuals in the household. To get the time deficit of the household, we add up the time deficits of individuals, right? So if somebody has a surplus, we ignore it. Why? Well, because we don't think that there is any mechanism within the household that would translate into those with surpluses compensating those with deficits, right? So that's the assumption that's behind that. If you're assuming, for example, a Beckerian unitary household, then you would want to add up time surpluses and time deficits to arrive at the household level measure of time deficits. We don't, because we don't believe in the Beckerian story. Now, what does this mean for the income or the consumption poverty of the household? Well, for that, we have the last equation, which shows the poverty line of the household. So what we are doing here is to ask what would be the poverty line if the household had to meet also the amount of expenditures that would be required to buy off their time deficits. For example, if you don't have time to cook for your children and for your family, how much would you have to spend on, say, meals that are taken out from a restaurant, right? Or if you don't have time to spend looking after your child, how much you would have to pay for a childcare provider. So the market substitute for that, right? It's a notional idea. So that's what's the term xj times p represents. So p is then the replacement cost for the household production services that's reflected by the deficit, right? Since that's a negative number, since household deficits are negative, we can just add that number. So it's basically an addition then to the official poverty line. So adding that to the official poverty line gives us the lim-tip or the lim-TCP poverty line. That's the term on the left-hand side. So that's the basic framework for accounting for time deficit. So if you think about the kind of improvements that we are talking about, let's talk about road improvements. That can reduce the threshold hours of commuting, right? So that can affect the time balance of the individual. Increased access to ECE can reduce the threshold hours of household production, RJ, and also can reduce the balance of forces within the household. That is by changing the variable alpha IJ in women's favor. But there are also indirect effects. Why? Well, because this fiscal stimulus is going to result in job creation, right? That can change the labor time or the time spent on income generation, the LIJ, for both men and women, right? And again, earnings of women in more income generation by them can change the balance of forces within the household, the alpha IJ variable, right? So that's item B. Then in item C, the change in the time, household level time deficit can change the poverty line, right? So that can again potentially change the household's consumption poverty status. Finally, we have to recognize that having more hours of income generation or having a new job can also add to households' income. That again can change the poverty status of the household. So let's now try to map the overall picture that comes from these considerations. Starting at the very top with the intervention, let's look at the ECE expansion. As we saw, that can change the time spent on household production by individuals, that can change the thresholds of household production. Also, by changing the bargaining variable, it can change how the household production responsibilities are split up among the individuals in the household. Change in the thresholds of household production, as well as the change in the sharing variable, can lead to changes in the time that individuals spend on household production. In turn, that can change to the changes in time deficit, and also changes in time and consumption poverty as a result of that. Looking at road improvements, we can see that can change the commuting time requirements, changing the thresholds of commuting through that mechanism, and in turn, that can change the time deficits. And in turn, that can also affect the changes in the time deficit. So this is what is going on in the micro level. But both of these measures, improving access to roads and ECE expansion, have macroeconomic effects, right? So let's look at that now. There's increase in public expenditures, which is the macroeconomic effects. And the way that model takes this into account is by examining, in particular, how the linkage variables. Now, these are the variables that link the macroeconomic outcomes, so the macroeconomic impacts, to individual level outcomes, right? So those are basically the employment and household consumption expenditures that the macro model generates. That has implications that additional employment opportunities and increased household consumption expenditures can change individual level changes in the time spent on employment, that can change to the individual's income or earnings, income from work. And in turn, we assume that can potentially change the bargaining strength of individuals within the household, right? So it can change the sharing variable. And in turn, changes in employment can also directly affect the change in time deficit, because as we saw in the time deficit, time balance equation, one of the variables there is the time that individual spends on employment. Together, taking the changes in the bargaining and the thresholds of household production, we can see that it will lead to changes on the time spent on household production at the individual level. In turn, that changes the time deficits of the individuals, and also then lead to changes in time and consumption poverty. Finally, we also have to look at the other impact of the macro, of the set of macro impacts, which is the change in household consumption expenditure. And that in turn can have a direct impact on consumption and time poverty. So basically what we are trying to do in the model is to translate this rather complex flow chart into a set of modeling steps. Okay, so that's what we are going to go through in the bulk of the discussion in the coming days. But the first step when you're thinking about this whole exercise, and when you think about if you want to apply or to be inspired from this work, or to take this work into account and use it in the concrete context, one has to be careful in how do you actually specify the policy interventions? What's the nature of such interventions? Because that's very important, because otherwise it's like garbage in, garbage out, right? That's the old usage for saying it matters a lot from the results that you get in a model, what you feed into it. So let's take a look at that, the rest of today's discussion, as to how we come up with the policy intervention. So looking at roads, the basic goal, I'm just trying to just give you a overall flavor of the research that went into it, not the intricate details, and you can read that in our report. So the goal for both countries is the elimination of roads in poor conditions, that is, roads that are not passable in all seasons. So for Ghana, for example, the policy goal that we specify is an elimination of poor roads in all types of roads, that is trunk, urban, and feeder roads. So if you look across the regions of Ghana, the percentage of poor roads range from 14 to 32%. And we come up with an estimate of how much this would cost. And we see that we estimate that it would be about like 1.4% of the GDP, Ghana's GDP in 2013. How do we come up with that estimate? Well, to arrive at the total cost, you need a unit cost and you need the total volume, or the total quantity of work to be done. So what we do is to use the unit cost for rehabilitation for each type of road, that is trunk, urban, and feeder. And we have an estimate of the total kilometers that have to be improved in these different types of roads. That gives us an estimate of how much is required to improve one kind of road. Then we add up across types of roads to come up with the total estimate. For Tanzania, the goal is different. And again, this reflects the condition of roads in the two countries. Tanzania road infrastructure is relatively less developed compared to Ghana. So here the focus is on eliminating the backlog of gravel feeder roads in poor condition and all dirt roads, right? So the percentage of poor roads, again, if you look at the variation across regions of Tanzania, range from like 75% in Manyara to 33% in Kagera, right? So the total cost again is we come up with that using the same methodology. You need a unit cost estimate and you need an estimate of the total volume, right, of work to be done. So it's that same method that's used to arrive at the total cost for Tanzania too. Turning now to the ECE, the early childhood expansion. Looking at the current situation for Ghana right now, it's only about 11% of kids in the age of 0 to 3 who are enrolled in creche. And for kindergarten, for 4 to 5-year-olds, that's a very good measure that they have enacted in the recent years. That's compulsory and it's free. And in spite of that, evidence indicates that participation is fairly low. Now, the policy goal that we postulate for Ghana is that Ghana reaches the same level of enrollment as a high achiever in the region, which is South Africa. So that's 31% enrollment in 2015. For Tanzania, it's a harder problem to pose a practical policy goal, and no data is available. This is part of the issue on enrollment rates for 0 to 3 years. Whatever evidence that we are able to gather suggests that the enrollment rate is very low, definitely below a quarter, 25%. The current net enrollment rate for the next age cohort, which are the 4 to 6 year olds, is under 40%. And the policy goal that we have postulated for Tanzania is to raise the enrollment rate for about for 5 to 6 year olds to 100%. This is consistent with their policy goal, national policy goal, as stated in the MQ Yukuta, which is the policy document of the government, right? So for costing, this is again tricky because there is no easy data available on the cost functions of childcare centers, but we can definitely determine the total number of children. Again, it's a volume measure that we need and unit cost. So that we can come up with estimates based on the census data. The cost per child, we estimated based on primary data. So we actually went out and collected data on childcare centers. And we estimate the cost per child from the information that we collected in those surveys. So the estimates are shown there. The fieldwork was done in Greater Accra in Ghana, and in Dar es Salaam in Tanzania. Now, these are urban centers of the country, so we make adjustments to account for what the average cost will be for the country using spatial price deflators. Now, just to end by noting the current policy context, there is really no policy initiative in either country as far as early childhood education is concerned. The kindergarten for the 4 to 5 year olds, as I said before, is now mandatory and it's free, but the capacity is simply not there, reflecting the fact that the government has not invested in this adequately. In Tanzania, the enrollment rate is extremely low. And even for the pre-primary, 5 to 6 years, because it's extremely low, it's under 40, it's around 40%. As far as roads are concerned, planned expenditures on roads in the last government budgets, it's a very low percentage of the GDP that is set aside. Ghana had an interesting initiative on called the Infrastructure for Poverty Eradication Program. And it promised like $1 million for each constituency in the election constituency, that is. But most of this money has been spent on public toilets, storage, warehouses, small dams, water supply, etc., and very, very little on roads. In Tanzania, most of the expenditures are devoted to trunk roads and improvements in the urban centers. So trunk roads, it makes sense because Tanzania is relying a lot on the mineral boom. So from the mining centers of the country, the deposits, the mineral deposits that are extracted have to flow to the port. So it's basically that type of an expansion of road network and road improvement that's taking place than the type of roads that really need improvement and just the most impact on ordinary people's lives, the dirt roads, the feeder roads, the rural roads, and so on. Okay, so I'm going to stop here, and now we're going to break into breakout sessions. And the questions that I would like you to think about, Catherine is going to be in charge of the breakout sessions, and the questions are here on the slide. The first one is to think about the contradictory impacts of expansionary fiscal policy that addresses say ECE or road improvements. It can create income generation opportunities for women, because even building the ECEs, a lot of women will find jobs in those facilities, right? But at the same time, this also raises, given that traditional roles of women remain unchanged or only subject to a little bit of change, they have this twin responsibility of meeting household responsibilities as well as engaging in higher income generating activities, right? So I'd like you to think about what would be required to alleviate the contradiction, right? And of course, there is no single correct answer. We have to think of a number of things to address this kind of real world policy problems. Okay.